welcome to another episode of the MMT 101 podcast. In this particular podcast, I will be chatting to Bill Blain. Bill Blain is a bond trader, the CEO of Windshift Capital Advisors, and the publisher of Blain's Morning Porridge, which is a daily commentary on global finance and markets. A few things to say before we get started. Bill is an unusual guest for this podcast as he's not an MMTer. Though he does have some views which are similar. But Bill is a man who's been working in finance for 4 decades. And as they say, that means he has a thing or two to say about that sector. We don't need to agree with the framework within which his ideas spring. And to be honest, there is much that we do not agree on. However, it does not mean that there's not things that we can learn from Bill's experience. You'll notice that I do steer clear from arguing, or I try to steer clear from arguing. Because I don't want it to be a podcast where Bill says one thing and then I disagree and then we get into a big long argument about it. I don't think that's healthy. I don't think that's useful because I stay quiet when I want to hear what Bill's got to say, because I think Bill does have things to teach us. He's sincere in his beliefs, he's not disingenuous, and as you'll discover when we chat, he's a nice guy. And he knows lots of things about the finance sector. One thing I would mention, so as not to confuse those who are MMTers and who know a bit about quantitative easing, which is something we do chat about. At one point, you might think I'm agreeing that quantitative easing is all about dumping money into the private sector. I just want to flag up that that's not what I'm saying. What I'm saying is that quantitative easing adds to liquidity, which allows banks and other financial institutions to buy other assets, which, like houses, which pushes up the prices of those assets and ultimately creates greater inequality. So you'll get to the bit and you'll hear me talking about this, but that's what I'm saying. I'm not saying the same thing that neoliberal economists would say, that it's quantitative easing is all about pumping money into the economy. Okay, before we start our chat, don't forget to subscribe to MMT 101, and if you've got some spare cash, please become a paid subscriber, because that helps me to continue this work. What is this work? This work is me trying to teach people about modern monetary theory, because I believe it helps us to change the world for the better. Okay, that's enough from me. Let's listen to my chat with Bill Blain. Hi, Bill.
Hi, Jim.
How you doing?
Very well indeed.
Good to see you. I'll give you some kind of context as to what was in my head when I first thought it would be quite a good idea to get you on to have a chat. I mean, I recall the first kind of banged against you when I put up something on LinkedIn, which went kind of semi-viral. Lots of people jumped on to tell me I was wrong, which is fine, you know, I have no problem with that at all.
Yeah.
But a lot of people are just very kind of rude. But I remember you being well-mannered and saying things which were from a different perspective, but were very kind of level-headed and kind of interesting. So I thought, yeah, this person's kind of different. And you were, I think you were probably talking about the finances. I thought, well, one of the things, I don't do it all the time, but one of the things I try to do is to try and speak to people that are not part of my silo of MMT, or, you know, just kind of speaking to the same people all the time and agreeing with each other, because, you know, you can quickly kind of fall down a hole and learn nothing, you know.
Yeah.
But it's quite good to learn from people that have got a different viewpoint. So that was why I was thinking at the time, well, this guy's not agreeing with me necessarily, but he's clearly got a viewpoint that hangs together as far as he's concerned and makes sense. So I could probably learn from that, and it's useful for the people that watch my podcast and read my stuff to get different perspectives.
Yep.
And of course,
that's great. I think we'll probably find that we have more in common. My background is largely markets, and as a bond trader, but I've always been fascinated in the economics of the markets.
Well, what we'll do is we'll start with, if you maybe just introduce yourself a wee bit about your background. I mean, one of the things, you know, which is also interesting about yourself is that you clearly got some things that are really the same as saying same things that a lot of MMTers would say. which is kind of unusual for somebody who's kind of working in the mainstream finance sector, because it's probably rare that you would meet up against MMT type ideas. But I read things and I think this guy's saying the same thing I'm saying. What's that
Yeah,
about?
yeah.
So, I mean, you can maybe talk about yourself, but also maybe we'll say, well, why have you, or how have you come across some of these things as well as
Mhm.
your sort of more traditional finance, bonds, stroke, gilts, etc.
Sure,
sector?
sure. Okay. Well, Jim, thanks very much for inviting me onto your podcast. It's a real pleasure to meet a fellow guitarist, a Scotsman, and
Yeah.
though you're a Ouija, I'm very happy to talk to you.
Yes.
You said introduce myself. How would I describe myself? Well, Bill Blain. I've been in the financial markets ever since I graduated with a degree in economics from Heriot-Watt way back in the early 1980s. And I sort of tumbled into the City of London. I started off as an accountant working for the government, the National Audit Office. But one of my mates had managed to get a job with some company called Morgan Stanley. I'd
Right.
never heard of them, but he gave them my CV. The next thing I was in for an interview, and I have spent the rest of my career working in the bond market. Now, I know the bond market tends to scare a little bit because it's full of jargon and it's awfully complex. But in fact, it is really quite simple. And there's a massive difference between the two parts of the financial markets. In one part, you have stock traders, people who buy and sell equities, and they tend to be optimists and they listen to stories. They listen to stories like how fantastic Bitcoin is, or how fantastic artificial intelligence is going to be, and how that's going to make them wealthy. And they tend to believe the narrative, and they're the guys who will rant and rave about how wonderful this narrative is. And then you've got guys like me. We are the practical people. We are the smart people. We are the bond traders. All we care about is getting repaid the money that we've invested in that bond. So
Yeah.
when we invest in anything, we want to know that the company or the government that we've lent it to is going to repay us. So we look at all the things that are likely to influence that repayment. And if the repayment is risky, we will insist on a higher rate of interest. If we believe that there's no real risk involved, which is typically the case with a government bond, and in the UK, that's the gilt market, we'll typically give a lower interest rate. So I've spent my whole career doing that. That's over 40 years now. Most of my time spent in London, but now I have escaped London. I live on the south coast of England. And after working for a number of investment banks and then getting involved in what we call the alternative asset markets, which is raising private capital or private equity for firms, my wife and I moved down to the south coast of England where I followed my passion for sailing, unlike
Mhm.
yourself, also collecting far too many guitars. But it's a great fun life. I go up to London 2 or 3 times a week. Now, a few years ago, we had a bit of unpleasantness in the market called the global financial crisis. We Scots can claim some involvement in that for Fred Goodwin and the Royal Bank of Scotland being at the core of that banking collapse. I understand it's the best play in the Edinburgh Festival this year, the story of how that all happened. Um, but at that point, I started for my clients. At that time, I was head of financial institutions at the number one Scottish bank, HSBC. Everyone thinks it stands for the Hong Kong and Shanghai Bank, but that's nonsense. The real name of HSBC is the Home for Scottish Bank Clerks. And that's where I ended up. I was head of financial institutions, and I started writing a commentary explaining what was going on in the markets. And I was looking for something healthy to call that, and I was launching it early in the morning. So I thought, well, a good Scottish breakfast cereal, porridge. So I've been writing the morning porridge since 2007, and when we
Right.
had the run at Northern Rock. And in that, which I try and do most mornings, I really take the discussions that I have with my clients in the financial investment side of the business, and then figure out what it all really means. So the last couple of days, for instance, in the morning porridge, I've been writing about how Trump's attack on the US Federal Reserve is likely to play out. And then this morning, I was defending the UK gilts market, the government bond market for the UK, which is under remorseless and very well ill-informed attack from places like the Telegraph newspaper. Now, I do call the Telegraph the Tory graph, and I read it religiously every morning to know what the enemy is thinking. I think that's an old joke from Ramsay MacDonald's day, but it is interesting to see how even financial markets have been politicized. The kind of assaults that you're seeing going on have effects on the bond market. And one of the things I've always thought is that the bond market is the most important indicator of what's really going on within an economy. And I know one of the things you wanted to talk to me about was my theory of the virtuous sovereign trinity.
Yeah, no, it's interesting about what you're saying about the connection between the bond market and the real economy. I mean, that is something I'm interested in, clearly, but I've not had enough time really to do research to either say, all right, okay, what are all these different uh, markers, and is it actually absolutely correct? Does the data support these assertions? So I'm not going to argue about it. So you will know a lot more about it than me.
I,
Uh,
I, I never argue about anything, Jim. I just
yeah,
lay out the facts
yeah,
and then mincingly ask you to disagree.
yeah. Well, that's right. No, it's interesting. It was funny because during your kind of back and forward, the emailing earlier on, it was clear that we're both got a slight competitiveness about us, which is good, you know. So if I say one thing, you'll say another. If you say one else, I'll say another. But that's not to say that we're not both correct.
Absolutely. Absolutely.
You know.
Let me try and give you my view of how important the bond market is for the whole
Yeah.
economy.
Before you do
As
that, we should probably say what that virtuous sovereign trinity theory is. I've got it written
Yeah,
down
that
in
that
my iPad here so that I wouldn't forget it. Because that was
yes.
one of the things we were talking about. We'd maybe chat about that. So before we
Okay.
talk about it, we should probably say what it is, you know?
Sure. Okay. So the virtuous sovereign trinity is something I came up with a number of years ago because I'm in the very fortunate position that Heriot Watt University in Edinburgh invited me to come and lecture their postgraduate course in
Hmm.
investment management. They were actually foolish enough to make me an honorary professor a while back ago. I guess that's because I was there for 5 years back in the late 70s and 80s. Um, but it was interesting trying to find a simple way of explaining how economies really work. And there's really three things that make up the virtuous sovereign trinity, and I'll try and connect them all together. The first is that any successful nation is likely to have a stable currency, and the larger the nation is, the more exchangeable, freely exchangeable that currency is kind of important. The second thing that's critical to an economy is to have a sustainable way of financing itself, aside from the tax base, and we call that the bond market. So you get some of your revenues in on taxes, but the bond market is there to make up the shortfall. And the bond market provides a great way for countries to leverage themselves, and we can explain that later as well. And the third stool of the virtuous sovereign trinity is this concept of political competency. And by that, you mean that you expect the government to do the right things to keep the currency stable, because if you end up in an unstable currency, you're going to end up with all kinds of inflationary or deflationary effects, and the sustainability of the bond market. And that's really the key to the virtuous sovereign trinity. And just a few years after I'd first started talking about this, we had the Liz Truss
Hmm.
moment, where Liz Truss came in and announced that she was going to make a massive program of unfunded tax cuts. And what she immediately did was create instability in the bond market. Now, that instability became consequential because so many investors buy gilts to back up their portfolios and the gilt yield was what we call very low, I think around 2% at the time. So they leveraged that. In other words, For every pound that they spent buying a gilt, they doubled that bet up. So when suddenly gilt yields moved quite dramatically, the effect of these leveraged plays caused the gilt market to sink very quickly because gilts are the most liquid, that is, the most easily traded instrument in UK financial assets. And as a result, there was a real sudden crisis in the gilts market. If the gilts market collapses, in which case yields would rise dramatically, that has all kinds of effects on the rest of the economy. It effectively reprices everything because, as I was saying earlier, we regard the UK government gilt market as the risk-free rate. You don't expect gilts to go bust. You think the government's always going to repay you. So that's the risk-free rate in the economy, which every other financial asset actually prices itself off.
Mhm.
And you demand a higher return the more risky whatever the other financial asset is. And so that very simple description, the virtuous sovereign trinity of a stable currency, a sustainable bond market, and political competency, generally if these three things are in place, the economy should be okay.
Mhm. Yeah, I mean, I kind of grasp what you're saying there, and I think when you first mentioned it to me, of course, I'm the man with all the questions, you know. I was thinking, okay, yeah, I can see that, but each of these legs uh, can be viewed through a different lens, so to speak, in terms of what you think stable government is, what that means, you know, and what kind of economic theory or school of thought you're coming from as to what stability is and what the government's for, whether it be for making sure there's full employment or that there's welfare for everybody, or making sure that there's no inflation or whatever, or concentrating on all the figures rather than the people, or, you know, is the stability, a stable government mean that they are following neoliberal practices and bringing in uh, what's the word I'm looking for?
Well, I think what you're saying, Jim, is the devil's in the
The
details.
devil is in the detail, yeah. So each
Yeah,
of these legs,
yeah.
there's a million questions to be asked in some sense about what is meant by, you know, a stable
Well,
bond market. You know,
yeah. Well, we have a very interesting situation going on, of course, in the USA just now.
yeah,
Uh, when we see the attacks that Donald Trump is making on the Federal Reserve, calling the chairman of the Federal Reserve, Jay Powell, a moron, and then trying to sack board members so that he
yeah,
can put his own people in place. In any other nation, I think we would turn around and say, wow, the independent central bank under attack, that's going to cause all kinds of ructions. That looks incompetent.
hmm,
Funnily enough, the US market is not reacting too badly to it, which kind of surprises us. But then once you speak to Americans, they will tend to take the view that he's our president. And that's whether they're a Democrat or a Republican. So they tend to be more accepting. And I think because the US economy, let's be honest, is stronger than any of the European economies, people aren't quite so worried about what the damage could happen. Certainly, if you compare what's happening in the States today with what happened during the brief regime of Liz Truss, we're far more worried about the competency of the UK government than we were about the
yeah.
US, which I find peculiar.
I mean, that was an interesting event because again, there was so many different interpretations of what happened there. I
Mm-hmm.
mean, I think the financial sector would tend to lean towards this idea that the power is all in the bond traders holding the government to ransom and all that kind of stuff. Whereas the kind of MMT folk would tend to think, well, wait a minute. When in fact the uh, people's what is he when you retirement funds were in danger, the government stepped in and started buying up and stabilized the whole thing, so to speak, which would kind of lean towards the sorts of things that MMT would say, that MMT doesn't necessarily see that the government and the central bank are two different things as such. They're part of the government sector, you know.
Yes.
And of course, the central bank It's not really independent, given that the main actors are always put in place by the government themselves, and the parameters within which they operate are all set by government. And the same thing in America, as you say.
I, I could not agree with you more, Jim. I mean, I think that's one of the reasons the Americans are so pragmatic.
Yeah,
I think they actually see that without saying it to
yeah,
themselves.
well, exactly. So in the Liz Truss case, the exchange rate, of course, plummeted
Mhm.
overnight, but within weeks, you would hardly notice any difference.
Uh, if I
In
can
some sense.
present the picture of a bunch of ducks swimming in the water looking serene, that was
Yeah.
the Bank of England and the Debt Management Office that runs the gilts and the UK Treasury and the Chancellor Exchequer, Kwasi Kwarteng at the time,
Mhm.
quickly replaced by Jeremy Hunt. They're all
Mhm.
trying to give the impression of calm stability swimming on the water. Underneath the surface, they were furiously paddling.
Yeah,
And
yeah.
the efforts, I think it showed real success. And I knew exactly what was going on because I'm quite close to a lot of the players there.
Mhm.
And they managed to connect a solution very quickly by stepping in and
Mhm.
maintaining the stability of the bond market. And that's maybe something we should come back to about just how central banks can intervene to create stability.
Yeah. Yeah. So again, that kind of fits to a certain extent with what MMT would say, so the power of a currency issuing government. Uh,
Look, we're going to
can,
go completely off track here,
yeah,
but I want to give you an example of
yeah.
some of the thinking that's going on in the bond market for the UK just now. Now,
Hmm.
we all know that the UK has a debt to GDP ratio of coming on for 100% um, of GDP. So if GDP is, was it 3 trillion at the moment, and we've got something like 3 trillion of debt, but we also know that the Bank of England still holds somewhere like 700 billion of gilts that it bought during the QE period.
Hmm.
Now, one of my big arguments is what I call zonk theory. And zonk theory is where the Bank of England is simply given a coin by the UK Treasury. And on the front of that coin is a picture of the king. And on the back of it is one zonk.
Yeah.
And a
Uh,
zonk is equivalent to 700 million. Now, that would be converting that 700 billion of debt into perpetual liability held by the Bank of the Treasury
mhm.
and a perpetual asset, zero coupon asset,
Yeah.
held by the bank. And the bank could put it in its rather good museum in Threadneedle Street for permanent display because it
Hmm.
would never be redeemed. But that
Hmm.
would effectively reduce the UK's government debt by about 30% the last
Hmm.
time I looked at it. Now, to me, that makes perfect sense. It would make our debt level look more sustainable.
Yeah, well, again, that fits in very well with MMT thinking, not in the same way, but I mean, an MMT person would say, well, okay, this debt is a number on a ledger,
Exactly.
right? But it's not like the debt that you or I have with our mortgages, or when
Exactly.
when we buy a new car and we've got to pay
The
pay the
Bank
car
of
up.
England holds that debt.
Yeah,
They are the asset side of the government balance sheet. The
yeah,
Treasury owes that debt. They are the liability side.
yeah,
Uh, It's all one company, country, whatever you want to call it. The two of them should be rounded off.
yeah. Well, again, that's all of that kind of stuff is stuff that I've written about, not in the same way as you maybe think about it, but sometimes I will argue with people who say, "Well, we've got this national debt." I say, "Wait a minute, it's not the national debt that you're thinking about; it's the government debt you're thinking about." And they go, "What do you mean?" So, well, I said the government may have a debt which is kind of the accumulation of all the deficits they've had, or uh, all the debt they've sold over the years. You say, "Oh, it's got this big debt." Okay. And I would usually say at that point, so what is the other side of that debt? Because if you loan somebody a fiver, and this makes no sense, this, but if you gave somebody a fiver, they're in debt to you of a fiver, or you're there's a debt there, but there's also the other side of the account. Where is the other side of the account in this government debt? And that usually stumps people because they've never heard of anybody talk about that before. It's always only the government debt. Well, the
Well,
other
that's an
side,
asset from the book of the
yeah,
guy that
where's
lost
the
the
assets? So
Bible.
I'm trying to remember the jargon. It's such a bad memory. And they won't know where the other side is. So, well, that was the non-government sector. Clearly, if you want to generalize and what is most of it, where is most of it? Most of it's in the private sector. And if you add
Mhm.
these two together, it comes to zero. So the nation has no debt. The overall balance is zero. But the government's got the debt
Exactly.
and the
Yeah.
non-government sector's got the asset. And
Yeah.
when you add
The,
them
the,
both
the
together,
problem,
you've got zero.
yeah, the problem that gets a little bit more complex than that because about 30 odd percent of the UK's government debt is held by overseas investors.
Well,
And they were the ones, if we were to simply say to them, oh, by the way, we're not repaying you because we've decided to write all this debt off, that could potentially get problematical. That's when you create geopolitical ructions when countries default. Now, many countries have defaulted in the past, and generally they get bailed out by places like the IMF, but you very seldom see a financially sovereign country like the UK
yeah,
go bust because we're borrowing in our own country, in our own
exactly.
currency, and we can repay in that currency. And you know what? We have the metaphorical keys to the printing presses to be able to do that.
That's correct.
There's
Yeah.
no reason to actually default.
So defaulting is always a political move rather than a financial move. It might be for some reason that they want to make a statement on something. Because again, people occasionally will say to you, but the UK government got a loan from the IMF after was it the Second World War?
Oh, it was 1970s sometime,
Right.
and Dennis Healy and whoever
Yeah.
Mark Callahan's government flew over to Washington, told the IMF, look, we've just seen sterling devalue about half. We're running out of reserves. Can we get a loan? We had repaid that loan off in a couple of years, and we only drew down a tiny little fraction of it.
Mhm.
It was there as a facility rather than a loan.
And it
Yet
was also
today,
political theater. It
yes, it
wasn't.
was pure political theatre. Today, I mean, within, I think, 12 milliseconds of Starmer winning the last election, you had whoever the Tory leader was saying, "Remember the IMF. This will not happen again." It is absolute nonsense. And just to illustrate that, if you ever read the Telegraph and you picked it up on Sunday morning, the front page story was in bold statement: Britain about to fail and go to the IMF for a bailout. Now, read that story and you think, oh God, we're in the end of the world. But it was complete fiction,
Nonsense. Yeah.
completely unsubstantiated. And basically, it was political drama. It was designed to make Labour look incompetent with the economy. Now, I try and present myself as politically neutral. It helps when you're doing, I have actually advised a former Tory chancellor, um, but I'd consider myself to be politically neutral. But when I see the kind of absolute right wing bullshit that is coming out about the UK economy, it just makes my blood boil. That's not to say we don't have problems, but I
Mm.
think these problems can be solved and they can even be turned into opportunities. And I think this is where markets and NM&T could actually get together if we could shake some of the conventional thinking that still
Mhm.
dominates the way that the instruments, the bodies that regulate and run government finances work. But that said, as I was saying right at the beginning, the government bond market does provide this risk-free rate, which everything else in the economy is priced off. And
Mhm.
maybe, Jim, that's something we should just talk about, the discussion you and I were having about QE.
Mhm. Yeah. I mean, as I was saying in my last email, I wrote an article about QE just, I don't know when it was, maybe it was a month ago. The idea, if you were to do it in the paper, is that the central bank is dumping a massive amount of money into the private sector, and that's
Let, let,
stimulation.
let
And
me
it's not
try and
that, of course.
explain. Let me try and just run through it. I think it's fascinating. Guys like you are what makes economics interesting, because you find a problem, you see it, and you say, explain this to me. So you go and learn it for yourself. I think
Yeah,
that's brilliant. But with QE, what happened was you could only reduce interest rates so far. And after the global
yeah,
financial crisis, interest rates were cut to zero. But they discovered that that had absolutely diddly squat effect on the economy. It
yeah.
did not create jobs. It
Well,
did not
that's one of
create
my
growth.
arguments.
The economy
Yeah,
flatlined.
yeah,
So they decided, right, we'll cut rates even further by using quantitative easing, which meant buying government bonds in the market. That's why the
yeah,
Bank of England owns so many. And that will cause the price to rise and the yields go down
yeah,
further.
yeah, yeah, yeah,
And so that's what actually happened. But everyone at the time said, oh, that's just pumping liquidity into the economy, pumping money into the economy. That's bound to be inflationary. But there was no inflation,
yeah.
no visible. And this is what surprised me when you sent me the email, Jim. You said we never found any signal of inflation. Well, from where I was sitting, it was completely different. I saw massive inflation, but it was in the price of
Yeah.
financial assets, and by
Well, I do
that,
mention that, of
stocks and
course,
bonds.
yeah, yeah,
And that's most
mhm,
clearly illustrated that
yeah,
from 2010 to 2023, generally accepted to be the quantitative easing era, the size of the US economy
mhm.
effectively doubled.
Yeah, I seen your note
But
on that.
yet the
Yeah,
size of the stock market went
mhm,
up by 400%,
yeah, yeah,
four times as much as the economy grew.
yeah, yeah,
And the stock market should really reflect the size of the economy. So that's a clear sign of just how much financial asset inflation was. And that today is the reason that US stock markets are still so
mhm,
overpriced. But in many ways, that was a good thing, because one of the things with stock markets is just like the housing market. If you have a strong housing market or a strong stock market, that creates consumer and business confidence. And so if you take a look after the QE era and you'd seen all this asset inflation in the States, the US economy was without doubt the Western economy that was doing best, was thriving the most uh, above all the others, and was certainly growing faster than any others. Whereas places like Germany and France, particularly, have effectively flatlined since the early 2000s. Britain's growth has been stop start lethargic. I think there's all kinds of structural rigidities, as we economists would say, that have created that in planning and in supply chains, all these things that economists typically warble on about. But certainly QE did not kind of create the kind of growth we have, but it has created something that I think is going to be with us for an enormously long time, and that is massive income inequality.
yeah,
Because what
absolutely.
you've seen is anyone who had a stock portfolio, their wealth doubled.
Yeah,
Anyone who was a worker and was relying on a salary, they actually saw their incomes fall, because
yeah,
inflation, even at 2%, meant that a 1.5% per annum pay rise means they are earning less today
yeah,
than they were in the 1990s. And so you can only make an economy work if people have the money to consume. And that just hasn't happened.
yeah. Well, that, of course, was one of the points I was making in my article. I mean, you've said what I've said in the article, basically. There's only two things that I pulled out at the end of it. Was the massive inequality that it created. That was the result of QE. And the other one was that it did affect interest rates. you know,
Yeah.
uh, but interest rates they thought would be a way of stimulating the economy, and MMTers would say it never does, it never
Yeah.
works.
Yeah.
Manipulating the interest rates up and down does not create growth in the economy. What
No,
creates growth in
I
the
actually think you need interest rates of about 4 or 5% to get people to invest so they get returns.
well, what the MMT folk would say is that that's not really the the thing that stimulates people to build businesses. It's a good idea. It's a kind of I mean, I don't mean business, to make business, banks lend money. Banks lend money when somebody comes in the door with a good idea that they think they can make a profit from. That's what
Oh,
makes.
Jim, we're going to have to disagree here again, because banks do not lend money anymore. That all changed after 2008. The new regulations that were brought in after the collapse of Lehman Brothers and Royal Bank of Scotland, um, they said banks have been taking too much risk, and the banks were all forced to de-risk. And all that
Yeah.
risk has now moved into the private sector that you were talking about
Hmm.
later. Now, the thing is, when a bank takes a loss because of bad lending, that immediately reflects. We have a saying in the financial markets that when banks die, they die quickly and suddenly because
Hmm.
they suddenly have a liquidity crisis. People come asking for their money back because they're worried about its stability, and the bank doesn't have enough money because for every pound that it takes in and deposits, it lends £12 in lending. So the banks no longer lend, and the people who do lend are all the big investments funds, whether they are pension funds or insurance companies or even hedge funds. And they can absorb losses better because if they take a loss, their life, they don't need to repay that money to the investor for a certain amount of time. So they can, the effect is less immediate if there are
Hmm.
losses in the market. So that's why the regulators are happy with this. But it does mean that all
Hmm.
that risk is outside banks now. And that has significant implications for the economy as well.
Yeah, no, that's new. That's new to me. I have to say, Bill, I haven't looked into any of that stuff, so that is
See the
interesting.
deep secrets of investment banking being
Yeah,
shared with you.
yeah. I hadn't thought about that. In fact, I hadn't even came across it in any way. So that is interesting.
Yeah, well, I think this is fascinating because it
Mm-hmm.
shows within the City of London and the financial markets, we all know these things because
Mm-hmm.
we're an insular little group.
Mm-hmm.
There are some of us who do have feet in both camps, the real world and the financial world.
Yeah.
But the way that finance has changed has been dramatic over the last 20 years
Mm-hmm.
since the global financial crisis. We had this period of massive low interest rates, which did not stimulate economies. We had this massive transfer of risk from banking into the investment sector. But the thing about risk is it's like matter. You cannot destroy it. All you can do is transform it. So you
Yeah.
transform it from bank risk, which is immediate,
Mm-hmm.
into long-term risk held by long-term investors.
Mm-hmm.
And that's where all the risk in the economy lies now. And maybe that's not a bad thing because Warren Buffett the
Mm-hmm.
sage of Omaha, the greatest investor the world's ever known, he will always say invest for the long term over 20, 30 years. Problem is the financial markets and banks especially tended to invest very short term, looking to
Mm-hmm.
make as quick a buck as possible. But if you
Mm-hmm.
have long term investment, then the immediate ructions that are caused by market movements,
Mm-hmm.
crashes, and collapses like 2007 become less apparent.
Yeah. I mean, if you don't mind me just saying some things about some of those things you spoke about there about, I agree with you that the UK and Europe has not grown clearly in the same way that America has. But I think there are contributing factors which are different from some of the things that you're talking about. And some of them are to do with the approach that the government has taken since 2008, which is that they have concentrated on austerity and
Mm-hmm.
the whole idea of balancing the books, which basically just means removing money from the private sector so that people are taking on risk, they're taking on loans in order to live, etc. From an MMT point of view, and that's all related to the use of monetary policy rather than fiscal policy, because of course the government, right-wing neoliberal governments tend to not like something called fiscal policy, which is just spending and taxing.
Mm-hmm.
So there's been no spending really into the economy. Uh, and that lack of spending is a big reason that, first of all, that the UK didn't recover quickly after 2008. They just didn't spend enough money. They just didn't put enough money to generate demand within the economy. They tried to use the neoliberal approach, balanced budgets, thinking that somehow, oh, we're in big debt. We'll try and draw down that debt because they think it's national debt. They don't think of it as government debt, which is balanced by an asset side. So they've got a wrong picture in their head. So they don't want to spend. because they think we can't afford to spend. So if you don't spend money into the private sector, you don't generate demand. When you spend money into the private sector, clearly you're putting money in people's pockets, not just the sort of money they get with QE, which goes into assets. You said it yourself.
Well, financial assets, which
Financial assets,
intrinsically do
property,
nothing for the economy.
the wealthy get all the money, and the inequality increases. The person in the street doesn't get any money from QE. It just doesn't work as a stimulus for the economy. But what does work is fiscal policy. But fiscal policy has not been put in place at all. Even by the Labour Party at the moment, they're following exactly the same playbook as the Tories. If we go back, I mean, one of the things I did, I mean, recently put out my MMT online course, and as part of that course, I did a small sort of history lesson post World War II, and I looked at the kind of coming of Keynesianism. So right after the war, you had a lot of problems clearly because the UK had in fact been helped a lot by America, so they had lots of problems, and they did actually have to pay back foreign currency debt, which is, as you know, the main problem. A debt in your own currency is not a problem; it's a ledger entry. A debt in somebody else's currency is a problem because you've got to get that currency in some way. But by the time we were approaching the 1950s, then Keynesianism came along, and that was all about spending money to generate demand. And that took us all the way up till the end of the 1970s, start of the 1980s, which is Thatcher and Reagan. So I kind of look at that area, that as part of my course, and say, what were the factors that made that what we call the never had it so good generation? Where we had the health service, we had people had things that in a level that they'd never had before, and they got houses, they got appliances, the education system exploded. So there was this kind of period of time for 20, 30 years where the government was spending money into the economy because that was part of the model of Keynesianism. And since then, that's not been the case.
Okay, so I'm trying to get this all in my head about what went wrong with all these multiplier effects that you're talking about from fiscal spending. And we know that in the 1950s, even the 1940s, immediately after the war, Labour went out and started spending building houses. And it actually created a boom. We had a housing boom created by building houses. We had a boom in the 60s because the government was supporting the building of new industrial plant. We talk, the famous proclaimers, strong, Linwood no more, building factories on the M8 corridor between Edinburgh and Glasgow. These things actually worked. And then you got a different thing started to happen in the 1979 election with Thatcher. Personally, I believe one of the biggest problems the UK faces today, this is when I'm wearing my policy hat rather than trader hat or economist hat, where my policy hat would say that selling off the housing stock and also encouraging people to believe that their goal in life was to own their own house, that actually created a massive boom in housing demand, which has led us to the situation where nobody under the age of 60 can even think about buying a house anymore because the house price is just out of order. We have no social rent accommodation. I mean, if you look in places like London and other big cities, I think Edinburgh and Glasgow both suffer from it as well. There are no flats available at levels young people can afford, and that has multiple consequences. It stops them forming families. The lack of family formation will be a big demographic problem, and it means they're giving up on work. My own daughter has just thrown in her job in London because her rent now exceeds the amount of money she's got left at the end of the month, and she's going off to do something else. That is going to be a crisis for the problem. But why is it we've got to that stage? It's because of long-term policy decisions, but it's also frictions within the economy have increased. Again, wearing a policy hat, one of the biggest problems we've got is nothing can be done in the UK because the planning system doesn't work. And people ask me, well, why is planning so bad? I'll tell you why planning's so bad, because it's not done by central government. It's done by local governments, and local governments are all bust. And the things they have to prioritize are number one, welfare, number two, welfare, number three, welfare. And on that list, planning comes about 20th. So all the planning officers do is try and preserve their departments by not doing anything that gets them noticed. And in cities like, I mean, I know this for a fact, that the nearest big city I live to is Southampton. And there are no planning officers there just now, because none of them have been replaced, because the local government could not afford to replace them, which means anyone wanting to build a factory, open a shop, build flats, anything in Southampton, completely stymied. So just that friction from planning slows the whole economy down. And you can look at the same thing in terms of supply chains, regulations on imports, the tariff situations.
No, it's also interesting. I mean, when you're talking about cities versus government, I always tend to think about it in the currency issuer versus currency user model. And the local governments are just currency users, and they're taxing the local people. And of course, they've got this limited. They do have limited finance, as we know.
They are bust. They're absolutely bust. They cannot function, and without local government planning, the economy can't function. It's that simple.
Yeah. So central government has got a role to play, and they're not playing it. Would be one of the ways I would look at that.
I don't know if we need central government, to be honest. I think planning
financially, I mean,
they should be taken out of the bureaucratization of all these systems needs to be addressed as well. I mean, the other one, that I always consider is the NHS, because it threatens to consume us all, because it has grown so big and is a ravening maw that needs to be constantly fed more money. But there are ways you could fix that. But the bureaucracies that are in place and the time it would take to put in things like artificial intelligence to control blood and treatment and diagnosis, all these things could be done. But the bureaucracy means that it's just going to be like swimming in treacle to try and move anything forward. And these are all, you presented a wonderful picture of, we could use fiscal policy to generate government spending on the projects that the economy needs to fix. And Christ knows, everything in the UK, from the railways, the sewerage systems, the education, the hospitals, you name it, they all need replaced. Basically, we have pre-World War II infrastructure for most of that stuff. But if we were to spend the money, my worry is that 60-odd% of it would be consumed in the planning process. There's a great story just now about this new bridge that they're trying to build, crossing they're trying to build across the Thames. They have spent over 500 million just in getting the planning applications in place to put in front of the planning committee.
500 million?
Yes. 500 million pounds just to get the planning documents that are over 500,000 pages. Planning documents to build a tunnel that no one's ever going to see.
That's interesting that I can't remember, there's a phrase about modern jobs. There's a certain sector of modern jobs where people are just kind of doing nothing other than kind of existing in an office space. Maybe there's quite a few of those jobs in that sector.
Just going off topic for a moment, I'm toying with the idea of writing Blain's new theory of economics, which will basically say, instead of looking at economies, let's look at individuals. What is it that motivates individuals? Now, you and I both have questing minds, which is a wonderful thing. But I think an awful lot of people, all they want is as simple a life as possible. So they satisfice their way through their career. And I see that happening in the financial markets all the time. And it absolutely amazes me. And you get these individuals end up in positions where they're managers. They're not the guys who go and make the money, but they get promoted to the managers so that the guys who actually make the money can continue to make the money. And these guys who become managers by satisficing, they then become the heads of the banks or the heads of the people. And they've never done a deal in their life. They've never traded a bond or a stock in their life, yet they're running some of the biggest investment firms in the world by satisficing careers. But off topic there, so
Yeah,
we'll go
yeah,
back
yeah.
to MMT, shall we?
Yeah, I suppose I don't know. The problem with all that kind of stuff is you start thinking about what is our lives for? What and what is the
Jim, that's easy. Our lives
yeah,
are for going sailing,
right.
playing guitar, and
Yeah.
eating good steak.
Yeah. I mean I would tend to be the opposite of the individualistic. I'm more trying to get community, seeing society as a big community.
Yeah, but
Uh,
it's comprised of
yeah,
individuals. You see, people think that markets are smart and clever, that they have some
yeah,
kind of intelligence, but they're not. All that a market is the weighted voting of all the participants.
yeah.
They are profoundly stupid.
Hmm, hmm,
Because if people are stupid, then markets are stupid. So thinking about economics, all that the economy is basically the sentiment and the activities of every participant in that. And some of us, are in penury, and some of us are billionaires and have a bigger vote in that. And
hmm.
so that's why I'm thinking about, if we're really going to understand how economies work, we really need to go out to understanding individual motivations and then building that into a big picture. And this is actually where AI could be really interesting.
Yeah, but understanding individuals is not enough. You have to understand systems, behavioral. You have to understand how people interact with each other and
Hey,
how
Jim, I've been
groups
trying to
work.
understand my daughter for 30 years and I still have
Yeah,
no idea.
yeah, yeah. I mean, one of the things again, this is the whole thing about like MMT would sort of look at this sort of stuff and say, actually, the individualistic sort of view is one of the problems
Hmm.
of orthodox economics, because they have a model of an individual, which is not real. It's the
Of course
idea
it's
of
not.
the idea of the kind of the person that knows everything and makes choices about what they buy and what they don't buy, based on this idea of I can't remember all the phrases, to be honest with you. This idea of the sort of satisfying themselves individually, sort of selfish. They're making selfish decisions about what will be best for them, and then magically
The
the
right
whole
wing call it rational
yeah,
expectation
that's the one. That's the one.
rating,
Absolutely. I can
which
never
is the
remember these things,
yeah, it's the biggest load of ball chocks that you'll ever come across.
Yeah, so there's a lot of people maybe have written about this in MMT and say, well, that's just all rubbish.
Mm.
Even demand and supply models are all rubbish because they don't actually work the way that
No, they
they
don't.
say they do.
Yeah.
Uh, and people are communal by nature,
Hmm.
and they're influenced by all sorts of things. One of the things about sort of orthodox economics is this notion that people are not, they take individual decisions. Well, if that was the case, there would be no marketing system, there would be no advertising, there would be no people out there trying to influence you because that's
Hmm.
what does influence you. So, you can't make an individual decision. You are part of a wider community and you're influenced by all sorts of things. So the
Exactly.
individual is just not a realistic starting point.
Well, yeah. Well, I think I need to think more about this because I really am coming to uh, a suspicion that unless we can model how it is individuals react to all the
Hmm.
stimuli around them and understand that from me up to the
Yeah.
65 million people that live in the UK just now, I'm not sure how we ever move economics from being a bunch of
Yeah.
sports arses like you and I talking about it into an actual real science. I mean, I've been studying
Yeah.
economics all my life and I find it
Yeah.
fascinating, but let's not kid ourselves. It's not a
Yeah.
science.
It's not a science. I'll tell you one of the things that I find attractive as an economist that I like, and I've interviewed and I've speak to him now and again, called John T. Harvey. He's
Hmm.
called the Cowboy Economist. You can look him up. Just type that phrase
Yeah.
into Google. You'll find him. Uh, but what he does and what he's just put out is his book at the moment, where he does a chapter on lots of different schools of economics.
Hmm.
Uh, and I have listened to most of his chapters because he reads them out. There's a podcast where he reads them out. Every now and again, he'll have another chapter. So he'll talk about, feminist economics, behavioral economics,
Hmm.
Austrian economics, Keynesianism, orthodox, uh, John, what was the Scottish guy at the start of all of this, whose name escapes me. But he takes each of these in turn. And he talks about it every week, or not every week, but in every chapter they get another one. And I find that a kind of essential approach. Don't just learn neoliberal economics, which is all they teach you in university.
Mm-hmm.
Don't just learn, dare I say it, MMT. Don't just learn one strand. You have to have an awareness.
You're getting me converted.
Yeah.
What should I read to educate myself?
Well, certainly John T. Harvey's book.
John T. Harvey, right?
John T. Harvey, the cowboy economist. Now, the trouble with these books written by academics is you can't necessarily walk into the bookshop and buy them for £14 or a tenner.
Yeah.
They tend to be shifting for like £250 and stuff like that. So I don't necessarily well, I should, if John ever hears me saying this, I never ever said it, but I can send you the podcast where he reads out his chapters.
Send me the link. I'm going to have a listen.
And those are free.
Right, I'll have a listen. I'll also do it. I was just peering at. I'm one of these people who has a great affection for books, and I try and read one book of economics a week.
Uh-huh.
And so every time I go up into London and go into the same wee bookstore, and I buy a proper book, and I've got it here, and there are some absolutely crackers on all kinds of different things, and it keeps you interested in the markets. And so I do consider myself to be widely read, but does that mean I widely understand? Probably not.
Yeah, well, the other good book, if you're interested in MMT, which I assume you are, although you don't regard yourself as an MMTer, and I understand that.
No, definitely not. Don't regard myself as anything.
You don't regard yourself as anything. But there's quite a good introduction to MMT by a guy called Dirk Ernst. EHNTS, I think it is. Dirk. D-I-R-K is a German fella. Again, I've interviewed him. And it's his book is very much a distillation. He writes very concisely. So it's not like a turgid read, if you know what I mean.
Okay.
But he's got a lot in the book at a level I think that you would understand, because some of it is kind of technical, I suppose. But I can understand it because I'm just at the right level in terms of what he's talking about. I've learned enough about it. And I find his book is a cracker of a book because it covers quite a lot. Again, I can send you that. There's quite a lot of really good MMT books. There's the one, which is another good one. Let's see, what is it called? I'll remember the name and I'll send you. In fact, no, don't need to remember the name because
there you go. Modern Monetary Theory. I think I have seen that. Yeah.
So it's Key Insights, Leading Thinkers.
Yeah.
So the first chapter in this is an absolute cracker, because what it does is it gives you chapter and verse on how money gets spent in the UK government. From a politician saying an idea about what they want to spend it on, the Parliament agreeing on it, and the process it goes through until eventually the central bank deposits or writes into somebody's bank account. It goes through the whole process, all the departments, it's all kind of designed so it's very difficult to see. It's opaque. So they unwind it all. So for anybody that's interested in the actual process of spending in the government, it's an absolute cracker of a chapter. Not many people will be able to read it because it's very technical. And I have to take my time. But somebody like yourself who's lived in that world will understand every word of it.
I'll give it a go.
Yeah.
I'll actually call it up on Amazon after this.
Yeah, so there's quite a lot of good books out there. Yeah. One of the problems with MMT is it gets caricatured into one or two things. Well, they're just MMTers. It's all about spending money, endless amounts of money, which will cause endless amounts of inflation. So it gets caricatured. But there is quite a lot of academic work in this area, but people just don't know that it exists.
It's translating the academic processes, which is where it gets interesting. And what's fascinating is guys like yourself and also my chum Mark Blythe, who's Scottish professor in the US. who has the same sort of inquisitiveness about finding out how the financial markets work in terms of economic theory. And it's having discussions like this where you look to see what are the potential solutions to the problems that we have, because we do have this very ingrained economic orthodoxy that runs everything. And then you get people who sit outside and say, this is daft, there are better ways of doing this.
Yeah.
Some of these ideas are very interesting. Some of them are potentially horrifying. Yeah, one of the really interesting books I read recently was about who is Satoshi Nakamoto, the supposed founder of Bitcoin. And you learn from reading that he's likely to be a conglomerate of people, which we always probably thought.
Yeah.
That he's sitting on an enormous amount of Bitcoin in his personal wallets. But that the whole genesis of that came from an extreme right-wing group of frustrated chaps who probably could not find themselves girlfriends. And that's where the whole idea of freedom money comes from, completely devoid of government interference. But yet now what crypto has become is stable coins, which simply link crypto to government money. And you begin to say, oh, this is all madness.
Well, the other book that's worth reading, if you're interested in that sort of wider aspects of all that, about neoliberalism and the kind of growth of it, there's a book called The Invisible Doctrine. I don't know if you've heard of that book. It's called The Invisible Doctrine, The Secret History of Neoliberalism. And it's by George Monbiot. Yeah, so you'll absolutely, well, depending on your point of view, if you are a right-wing maniac, you won't enjoy it because it reveals all sorts of stuff. But
I've read many of George's books.
Well, you'll really enjoy it then, because, and it's also quite frightening. It's one of these books where you think, my God, this is unbelievably awful.
Look, this is absolutely fascinating, but there are also, you've got to connect what you're doing into what the real economy is doing, which we see through markets. And having worked for over 40 years in markets now, I've come to some very simple conclusions. And some of these I put into the form of Blain's market mantras. And the one thing I would ask all your listeners to consider is my second mantra, which is things are never as bad as we fear, but seldom as good as we hope.
Yeah, well,
if you're ever going to look at markets, that's a great way to think about things. That markets love to scare themselves, reading all the horror stories that appear in the commentaries every day and the news headlines. But things seldom end up as bad as suggested. We do not see the financial cataclysm that everyone is predicting the whole time because they are self-adjusting, because expectations change and these affect the prices in the markets. Even the worst financial crisis that we had with the collapse of Lehman Brothers in 2008, it wasn't half as bad as some people were predicting, because we do tend towards a trend towards stability at all times. So the key thing is keep up the good work and don't panic too much about the bankers like me destroying the economy while they're sleeping.
Okay, Bill, I think that's probably a good place to stop. I've really enjoyed our chat. Thanks a lot for coming on. I really appreciate it.
No, it's been really interesting, and I love opening up to new things. And I was so glad when you came back to me after I abused you on LinkedIn.
No. I mean, as I say, I can tell what type of person by the way they speak. If you know what I mean. Even if it's typing, I can usually tell that they were a good guy that are worth talking to. Some people are very abusive. Okay, that's your lot for this episode of the MMT 101 podcast. I'd like to thank my guest, Bill Blain. And, well, before I say I'll catch you the next time, don't forget to subscribe. And as I said at the start, if you've got any spare cash, please become a paid subscriber, because it really does help me to keep doing what I'm doing, which is to teach as many people as possible about modern monetary theory. Okay, I'll catch you the next time. Bye for now.